help them hold stablecoins do so in a safe way. Existing federal and state laws provide standards for custodians and should be useful in this context. 6, what other legal regime should apply to payment stablecoins and related products and services? While I have focused primarily on prudential issues, payment stablecoins and related products also present other common regulatory concerns, such as those related to consumer protection and illicit finance. All of these considerations should be thoughtfully explored. But this does not mean that the securities laws should apply to payment stablecoins, nor does it mean that we should be vexed to paralysis in trying to answer questions that, frankly, permeate traditional finance, such as how to regulate any service provider that's adjacent to a regulated firm. Ultimately, consumers in our financial system more broadly will be best served by focusing on the issues I outlined, where I believe we can find common ground. Thank you.
Thank you, sir. Ms. Huang, you're recognized for 5 minutes for your oral presentation.
Good morning. Thank you, Chairman McHenry, Chairman Hill, Ranking Members Lynch, and Ranking Member Waters for giving me this opportunity to testify. People like me rarely have this opportunity. I do not represent a large corporation or an industry organization. I am an independent lawyer and entrepreneur working with grassroots organizations. While in my past life, I worked for a Wall Street bank and Wall Street law firms. The work I do now is a labor of love, working with community organizations to design local currencies that make money work harder for local communities. Indeed, my company is called Humanity Cash because we want to make money personal again. During the pandemic, I studied the history of community currencies, which are not legal tender, but they complement national currencies as a local medium of exchange to ensure more money recirculates and stays within local communities. In the United States, where we enjoy the world's reserve currency, one downside is that the US dollar sometimes works minimally for local communities, with most of that money benefiting big banks and large corporations. Therefore, the goal of a local currency may be to promote patronage of small businesses and local banks, which recirculate deposits back into the local economy in the form of productive loans, creating a money multiplier effect. This is the model of a local currency in Berkshire, Massachusetts. During the pandemic, small businesses were under and continue to be under pressure. The pandemic also accelerated the shift towards contactless payments. This means that more money is leaking out of local economies. Even if you shop locally, if you pay with a credit card, the local economy loses out on the money multiplier effect of that dollar being put to work by local banks, as well as the 3 to 4% transaction fees that are taken off the top. I saw this as an opportunity to address a real-world problem that blockchain was suited for. By digitizing a local currency, we can better compete with credit cards, reduce transaction fees, while ensuring that the underlying dollar reserves remain deposited and therefore invested in the local economy via local banks. During the process of designing and launching a digital local currency, I interviewed small business owners, community bankers, and ordinary citizens. Whether in the Berkshires or across the United States, from Puerto Rico to Hawaii to Indiana, the people I've met are not interested in crypto as a speculative investment, and neither is anyone in this room. We are all deeply passionate about making money work for our communities. The we includes a concrete mixer driver, a retired accountant, community organizers who support Black-owned businesses, a small business owner who produces Massachusetts-made ukuleles. As grassroots entrepreneurs and community innovators, we need risk-appropriate regulations that will not be cost-prohibitive while providing guardrails to protect us from bad actors. Chairman McHenry's stablecoin proposal strikes a good balance between these two needs. Importantly, it provides space for local initiatives and innovation through state regulators and a clear roadmap for implementation. This proposal also provides the groundwork for community financial institutions as well as non-bank institutions such as economic development groups to staunch a flight of deposits from local communities. Payment stablecoins enable higher quality deposits as we can transact amongst each other without needing to withdraw the underlying dollars. The urgency of keeping deposits local is more important than ever in light of the regional banking crisis. The community banks we work with in Massachusetts recirculate 70 cents of every dollar back into the local economy compared to just 20 cents for large banks. Long-term, blockchain technology can replace outdated banking and payments infrastructure. which is currently limiting the ability of smaller banks to innovate and compete effectively against big banks and fintechs. With the right policies, starting with the stablecoin proposals, we can enable our financial system to be more competitive and more responsive to local economies, a benefit that ordinary Americans deeply desire. Thank you.
Ms. Reynolds-Hand, you're recognized for 5 minutes for your oral presentation.
Thank you. Good morning, Chairman McHenry, Ranking Member Waters, Subcommittee Chairman Hill, Ranking Member Lynch, members of the subcommittee. Thank you for this invitation to testify. My name is Delicia Reynolds-Hand, and I serve as the Director of Financial Fairness at Consumer Reports, where I lead the organization's work in digital finance. At Consumer Reports, we examine what fintech products and services actually do for consumers and how they rate alongside each other. Do they actually live up to what they promise? As I testified recently, the convergence of new technologies and new forms of assets have made cryptocurrencies particularly appealing for consumers whom traditional finance has never appropriately served. In a volatile and stressed economic environment, consumers and investors are at an even greater risk in the absence of rules and noncompliance with regulations to protect them and prevent the misuse or exploitation of these assets. Since the last conversation on stablecoins, Europe has succeeded in bringing crypto asset issuers, and crypto asset service providers under a regulatory framework. And today, we have 2 bills under consideration. I hope we can land in a good place for consumers. Consumer Reports urges this committee to work together to achieve effective and comprehensive regulation of stablecoins. This is especially important for responsible innovation, financial stability, and financial inclusion. Appropriate regulation, supervision, and oversight needs to be implemented before stablecoins become a greater risk to financial stability, safety and soundness, and the smooth functioning of payment system. To be clear, this space will be regulated and new frameworks will be developed. The question is whether the development will be driven by crisis or collaboration. We support updates to the committee draft, which include federal regulatory review to ensure the safety and soundness of stablecoin issuers. And we encourage the adoption of provisions in the bill granting the Federal Reserve Board authority to reject state licenses. Not including these provisions creates regulatory arbitrage, which could drive a race to the bottom instead of a race to the top. These are lessons we have failed to learn from the past. Keeping with the tradition of congressional application of the Commerce Clause, the law should be the same across all 50 states. The committee draft could also go further to include specific key requirements which parallel requirements for traditional banking. While both drafts retain some equivalent requirements to provide information about the organizers, senior management team, capital adequacy, we urge the committee to also retain requirements to promote diversity and inclusion in the compromise bill. We support the addition of requirements for federal regulators to issue rules related to risk management infrastructure. Second, while the committee bill outlines a role for federal oversight, it does not require entities that become stablecoin issuers to be insured depository institutions. The compromise bill, however, makes clear that issuers shall not represent stablecoins as insured depositors. We would encourage adoption of this language. We are most concerned about the removal of key text in the committee draft, maintaining separation of banking and commerce, prohibiting non-financial commercial businesses like Facebook or Walmart from owning a payment stablecoin issuer. Additionally, we would encourage the adoptions of stronger consumer protections. The bill sets up a regime to approve issuers of payment stablecoins, but it doesn't outline adequate consumer protections for payment activities conducted or facilitated by issuers or their coins. We urge the committee to move forward with the provisions in the compromise bill that requires stablecoin payment regulation, additionally to be technology neutral to promote interoperability and to ensure stablecoin arrangements share common features with the traditional financial system. Related, we also request that the committee adopt language associated with strong oversight of custodial wallets, as the committee draft does not cover all assets held by custodial wallets. We do not need another Lehman Brothers. And in the event of another insolvency, a bankruptcy court could reasonably view, as they have in Celsius, that commingled funds are grounds for giving the company and its creditors priority access to those funds rather than stablecoin holders, the rightful owners. Lastly, we urge explicit clarification on how and when the SEC can and should regulate in this space. Thank you again for the opportunity to testify.
Thank you for your testimony. We appreciate all of the testimony from our witnesses. We'll now turn to member questions. The chair recognizes himself for 5 minutes. Mr. Homer, interesting comments you made about validation of the reserves for a stable coin, and you referenced the ability to do that on an inter-day basis versus the way the bill's drafted. Is that technology readily available for a stable coin issuer to provide an inter-day valuation of their reserves and transparency on that? I think your mic, sir.
Thank you for the question. And yes, the technology is available. I think there'd be two aspects of it. One is the number of stablecoins that you have issued, which is available publicly through the blockchain. And then the second aspect of it would be technology to show that the backing assets match that on a one-to-one basis. And both of those things can be accomplished.
Right, and then that would obviously be backed up by the attestation and monthly financial reporting and then audits. Yep, thank you. That was a good comment I thought you made. In our last hearing, we heard from testimony from the New York State Supervisor, Superintendent Harris, on the role of state regulators. She described how state regulators can regulate payment stablecoin issuers and how a regulatory regime could be built on a well-established dual banking system that we have in our country. I think it's important as we work through the drafts that we strike the right balance there. I think it's a key, effectively, a difference between these two drafts and one that we're going to try to figure out between both sides of the aisle as we work through this. And naturally, it's an area that the Federal Reserve cares a lot about since they'd be the primary regulator for federally qualified non-banks, and in our Republican draft, we have the Comptroller of the Currency as the primary federal regulator for national trusts. In our September bill from last fall, the Maxine Waters Patrick McHenry bill would be required to have any state chartered issuer also register with the Fed. Mr. Homer, striking a balance there, what's your view on making sure we get that balance right?
Yeah, as you pointed out, I think that balance is very important to get right for a number of reasons. Most importantly, that we want a competitive marketplace. I've been a federal regulator and I've been a state regulator. I think both regulatory systems are important to the stability of our financial system. I will say with certainty that state regulators are much closer to the ground. They know their local constituents much better. They're much more able to effectively calibrate a regulatory environment that meets local requirements. The state pathway is important because if you are someone that's starting a financial services company, that's where you go to get licensed or chartered for the first time.
But you know the ranking member's concerns about a race to the bottom, right? You've been a state regulator and an FDIC employee. Can we strike that balance with the way we've approached it in the Republican bill, you think?
I think so. I think in both of these bills, there's a strong federal floor. I would argue that a race to the bottom is not possible.
Okay, good, thank you. So let me turn to you, Mr. Portilla, on the issue of the OCC charters. You know, the Comptroller of the Currency had two digital asset firms that they had given conditional approval of to act as a trust, and those conditional approvals now have lapsed, like so many things around our lack of a regulatory framework, adding to the frustration here. The Republicans on this subcommittee sent a letter to the agency pointing out its inconsistent approach in reviewing national trust bank charter applications. Could you discuss the benefits of allowing the OCC to serve as the primary regulator for any stablecoin issuers that receive an OCC national trust charter, please?
Yeah, thank you for the question. I think the main benefit of having the OCC serve as the primary federal regulator for a stablecoin issuer that has a national trust charter is that you avoid multiple federal regulators of the same entity. And in addition, the OCC is at heart a supervisor and an examiner of banks and trust companies, and so they're well qualified to, to do that.
That's helpful. Let me yield back the balance of my time and call on my friend from Massachusetts, the ranking member of the committee, for his 5 minutes of questions.
Thank you, Mr. Chairman. Mr. Homer, interesting. How many stable coins are registered in New York State?
There are, I believe, currently 3 companies that have been chartered to issue stable.
And how many
maybe 5
stable coins are there?
I believe it's 5.
No. How many stable coins are in existence right now?
I mean, there are probably,
20,000, I think.
yeah, they would claim they're stable coins.
Yeah, so 5 out of 20,000 are registered in New York. I think that's evidence of a race to the bottom right there, where stable coins are trying to, and crypto companies are trying to go to the areas with the least amount of regulation. I also worry, and I know you've done extensive work in New York. We had Ms. Harris in yesterday, and I know people have done a lot of good work in New York around this issue. But the practice, I mean, a race to the bottom is not possible. A race to the bottom is the practice, is the custom of this industry, to go offshore and seek areas of least regulation. I compliment the state of New York for the work that they've done. However, my feeling is that if we directed this to 50 states and territories perhaps, that practice would continue and that cryptocurrencies would seek out those areas, those jurisdictions that offer the best opportunity for them to maximize their profit and avoid cumbersome and costly regulation and disclosure. That's what I worry about here, that we not engage in that type of practice where New York would be penalized for having a robust regulatory system. They would run elsewhere. There are other states that are in the game here, we all know who they are, that are offering themselves as safe havens that offer some real concerns. But anyway, and I do appreciate you all being here and helping us. This is a learning process, and we're all trying to understand this in a better way so that we can craft this legislation and come to a meeting of the minds. I deeply respect the chairman, Mr. Hill, and I know he's a good man, and we're trying to get to a good situation on this. But Ms. Reynolds' hand. The Fed, back in February of this year, the Board of Governors offered guidance on member banks regarding the use of digital assets within the federal banking ecosystem. And they said they were offering this guidance because of rampant fraud. The rule that they promulgated covered 2 directives. One was to presumptively prohibit holding crypto assets out of safety and soundness concerns. And the rule also noted significant risks associated with cryptocurrency sector, including fraud, legal ambiguity, and volatility. So they also said, this really got me, in the absence of a fundamental use case, the value of most crypto assets is driven largely by sentiment, and future expectations, and not by cash flows from providing goods or services outside the crypto asset ecosystem. So, in light of so many of these stablecoins breaking the buck, becoming depegged, wreaking havoc for those who hold this, because of the inability of depositors and investors to get their money back in redemption, is this something that we want to tie to our traditional financial system and give access to Federal Reserve discount window or access to Federal Reserve services?
I would say we certainly shouldn't start there. With so much volatility and disruption occurring, we shouldn't open up the federal purse, frankly, until industries are proven to be safe and we cut down on rampant fraud and other abuses. We should start first with clear rules of the road and strong protections for consumers. Then once proven, we should add the additional programs that companies are interested in.
That's great. Thank you. Mr. Chairman, I yield back. Thank you.
Ranking member yields back. Mr. Davidson of Ohio, the Vice Chairman of the Digital Assets Subcommittee and the Chairman of our Housing and Insurance Subcommittee. 5 minutes.
Thank the chairman. Thanks for our witnesses and frankly for the colleagues who are here to help make good policy. Try to stay calm and measured in my responses here. But the whole point that we're trying to do is provide a clear legal framework for the entire country so that no one state can game the system, or frankly, so that people aren't driven offshore out of our capital markets and our regulatory framework. Often they're fleeing our markets to find certainty. So it'd be great if we'd provide some. Been working for it for a long time, as have many of you. Speaking of efforts, people say, oh, there's a lack of stability. A lot of the same people are working to create a lack of stability. So, Mr. Homer, this year it's become fairly apparent to many people in a bipartisan way that the traditional banking industry has started taking a hostile position with digital asset companies in the space they operate in. When Silicon Valley Bank failed, some people pointed to digital asset companies, one of which was a stablecoin issuer, and said they held too much of their capital at one bank, Silicon Valley Bank. When Signature Bank failed, people claimed that maybe it had something to do with digital assets. Barney Frank, former chairman of this committee, said it didn't have anything to do with that. The director of New York Financial Services, who was there for the whole thing, said it didn't have anything to do with digital assets. So where are they going to go for banking? Could you speak to the harm that comes with debanking the industry and the damage and, frankly, lack of stability that it's caused?
Yeah, thank you for the question. I think it is something that has been a challenge, that it has become much more difficult for companies in the space to find banking services, even for the most basic of services, to find an account for payroll, for example. I think, unfortunately, what that will lead to are people looking for alternatives that are, in some instances, offshore.
If you can't deposit your cash in America, you're probably going to deposit your cash somewhere, right?
Right.
So, then they'll point to that and say, see, they're offshore. Well, yeah, you drove them there on purpose, I might add. So one of the overlooked aspects, let me just address this. Could a stablecoin go to zero? How in a regulated stablecoin that is backed by assets, high-quality liquid assets, or, frankly, commodities, physical custody of commodities, would that really go to zero?
Under this proposal, it'd be very difficult to foresee a scenario in which
There would have to be complete fraud. They didn't have the assets, right? Could somebody in that case where you had full custody of the assets that you say you have, whether they're high-quality, level 1 high-quality assets or physical custody of a commodity that backs it, could it possibly go to less than the value unless there was actual fraud?
it would be very difficult.
I think that's the case, and that's the whole goal of the regulatory regime we're trying to put in place here with stablecoins. As we confront a debt ceiling and the fact that this town spends way more money than we collect in revenue for a long, long period of time, we're spending more money than anyone will even lend us. There seems to be a shortage of demand for treasuries. So, given that the most frequent backing for a stable coin, so that it really is fully backed, is treasuries. Mr. Portilla, could you talk to the important linkage that stablecoins would create for demand for U.S. dollar-denominated treasuries?
Right, yeah, thank you for the question. I think you're right. If if stablecoins are required to hold their reserves in high-quality liquid assets, which of course includes short-term treasuries, there would inherently be increased demand for those assets from those issuers. So I think that's right.
Yeah, but, so I think it could actually help us solve a number of problems. And then the last thing, in terms of the payment space, you know, frankly, for a lot of people, they look at a stable coin in many ways superior to a fiat currency because while the fiat currency is backed by the full faith and credit of the United States, and we could just print more money, you have a hard time guaranteeing that it'll buy the same amount of goods. But in the case of stablecoin, it is fully backed and could be backed by physical custody of assets as well. My time's expired. I hope we land on something in a completely bipartisan way, and we can get this done. I yield.
I thank the gentleman. Mr. Foster, who is the ranking member on the Financial Institutions Subcommittee, is recognized for 5 minutes.
Thank you. Mr. Homer, you mentioned real-time monitoring of reserve balances versus tokens issued. Wouldn't it be actually easiest and safest to simply require as part of the minting process that a digital attestation from the Federal Reserve that the amount on deposit in the relevant account at the Fed exceeds the amount of tokens that are proposed to be in circulation following any proposed minting operation? So, you know, basically that any proposed minting operation would not be cryptographically valid until it was accompanied by a Fed attestation that the assets are actually there on reserve. You understand where I'm going on this? It seems like this is a very unburdensome operation to require for both the Fed and the issuer.
I think they could be complementary. If we're thinking about trust in the market and how do we produce trust, I think real-time dashboards could assist that. But of course, attestations from a regulator or required by a regulator are important and probably not in addition to that. I don't think they're mutually exclusive.
Yeah, well, I'm worried about the sort of abuses that we saw with flash loans and stuff, where even, you know, for a fraction of a second, you can have weird things happening and all of a sudden a giant fraud has taken place. Whereas if you'd simply said the minting is not valid until the Federal Reserve says, yep, they are there, you know, before, during, and after the minting operation, you have some excess buffer of reserves. It seems like that should be an absolutely solid way of guaranteeing. Also, that approach, it seems to me, really eliminates all the worries about monetary effects because there's a one-to-one ratio, which you emphasized. You know, fraudulent issuance runs on stablecoins. That would all just disappear if we adopted that approach. So I think there's a lot to be said for it. Ms. Wang, in your testimony regarding Humanity Cash projects, I see that you've kind of independently discovered and implemented the two principles that I believe must be included to have controlled privacy and security that will be needed to avoid fraudulent and criminal use of stablecoins. Firstly, in your testimony, you state that the use of a blockchain ledger can also cost-effectively and transparently meet part of the public reporting requirements under the proposed stablecoin bill. For example, you can show in real time that the number of tokens on-chain compared to the US dollar reserve balances is what we've just been talking about. But secondly, I was very pleased to see that you've also attached what amounts to be automobile license plates on each digital wallet. That something that I've been advocating in this committee for quite some time. That in your testimony you state that, quote, at the point of wallet creation, we collected information regarding username and contact information associated with each wallet, not available to the public on a public ledger to preserve user confidentiality. And then you go on to explain why it would, the advantages of that system. And so let's spend a moment looking through the privacy implications of this to see if it's a comfortable place to land. For example, if a person uses Humanity Cash to buy a secret gift for their secret lover, and with no criminal activity involved, can they expect that it will remain anonymous and secret?
Yes, so the blockchain itself doesn't show any personal identifying information, but we can also design systems that preserve the balance between preserving your privacy versus law enforcement needs. So one of the other areas that I've done work in is around digital identity. So you can, for example, have the DMV or a bank issue a digital token that represents like a KYC credential, right? So your
Yeah, the
identity-
so-called mobile ID or digital driver's
Right, and so
license.
a wallet can hold that digital identity token to signal that it has been checked. And then therefore you can have safe transactions without needing to actually know who that person is unless there was a compliance reason to reveal the underlying information.
And the other members of the committee know that I'm a huge fan of mobile ID as well. Now, on the other hand, if there's a ransomware attack, say, attempting to use Humanity Cash as a payment, and someone's screen locks up and says that in order to decrypt your computer files, we want you to transfer this much Humanity Cash to this wallet, then I presume you can go to some judge somewhere, prove a crime has been committed, and de-anonymize the owner of that wallet. How does that take place? What's the mechanism for controlled
for-
de-anonymization?
Well, in our specific case, I think the chances of that are pretty low because you would only be able to spend it locally.
Understand, but we're talking about systems that
Right,
make
but at a
scale.
systems level, there'd be ways to prevent against that. You would know exactly where the money's been transferred, but you can freeze, for example, compromised tokens, and so they would no longer be transactable after the point of attack. And then you still have the underlying real-world assets, right? The deposits in the bank, all of that remains safe, right? So we can then
Thank you. I
reissue-
think my time is up, but your project may be small, but I think you've seen the future pretty clearly.
Thank you.
Thank you, Dr. Foster. We now turn to the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you, Chairman Hill and Ranking Member Lynch for holding the hearing, and thank you to all of our witnesses for your time today. I'd like to also thank the chairman for noticing Chairwoman Waters' stablecoin draft to this hearing to give us the opportunity to discuss some of the bad policies that it includes. For instance, it would require each stablecoin issuer to disclose so-called diversity statistics, which have nothing to do with the financial stability of the issuer. Additionally, the Waters draft proposes to push forward with a study on a central bank digital currency, which has been called the single greatest assault to financial privacy since the creation of the Bank Secrecy Act. Now, since time is limited, I want to dive directly into my questions. Mr. Morgan, the U.S. dollar is the world's reserve currency, accepted all around the world because it is backed by the full faith and credit of the U.S. government. In that sense, it is the original utility token. I see the value in U.S.-based stablecoins to facilitate payments. So, Mr. Morgan, if we are going to use blockchain technology and crypto rails to facilitate payments, is it essential to have a less volatile asset like a U.S.-backed stablecoin than, say, Bitcoin or an Ethereum-based token?
Congressman, thank you for the question. We think that that stable asset is a critical piece of facilitating real-world value. In particular, we believe tokenized deposits are one path to do that. Today, bank deposits are 73% of money in the U.S. economy. Stablecoins are separate and apart from that, but we believe that competition from well-regulated parties for the form of that money can only benefit the economy.
Thank you. Mr. Portella, the McHenry bill does not include a requirement for a report on financial inclusion, which was included as part of an earlier draft. It also does not require regulators to consider financial inclusion when evaluating a stablecoin issuer's application, which is also required in the earlier draft. Mr. Portella, does information pertaining to diversity and financial inclusion have any bearing on whether the stablecoin issuer is capable of operating a stablecoin in a safe and sound manner?
Yeah, thank you for the question as well. No, I think the safety and soundness factors in the proposed legislation, both of the proposed pieces of legislation, are different than what you might call the community benefit or the financial inclusion standards. I think the financial inclusion or community benefit standards are not going towards safety and soundness, they're addressing other policy goals. I think those are borrowed from our banking laws where those factors are required to be considered under the banking statutes for mergers and acquisitions, for example, for different reasons. For example, classic banking is taking deposits and making mortgage loans, and Congress in the past has worried about banks making decisions, who they're lending to. to me, that doesn't seem opposite, that's not relevant to the business of a stablecoin. They're not making those types of decisions. So I think there's a question of how, if that's the right piece of the banking statutes to draw from for stablecoin legislation.
Thank you, I agree. Mr. Morgan, tokenized deposits have a role to play in utilizing the benefits of the blockchain in our payment systems. Can you address the benefits of tokenized deposits and how they differ from traditional stablecoins?
Congressman, thank you for the question. We believe that this is a critical distinction. Unlike stablecoins, tokenized deposits are not designed to connect that broader crypto ecosystem to the real world. Tokenized deposits will not trade on exchanges, in most cases will not be held by the general public. They are simply back-end infrastructure that can bring the innovations associated with blockchain technology into the traditional banking space.
Thank you. Mr. Homer, how do we ensure that stablecoin issuers work with their regulator to utilize an appropriate amount of on-balance sheet liquidity and concentration limits to offset the risk of withdrawals in a stress scenario based on their risk profiles?
Thank you, Congressman, for the question. It's a great question, and it really speaks to the importance of a prudential supervisor being the primary regulator of stablecoins. And that is the balance the stablecoin issuers have to strike, a balance between stability and liquidity. And prudential supervisors have an important role to play there in helping them think through scenario planning to get that right.
Thank you. I see my time's expiring. I yield back.
Gentleman yields back. The gentleman from California, Mr. Sherman's recognized for 5 minutes.
I'm here to channel Nancy Reagan. Just say no. To crypto and to so-called stablecoins, the biggest oxymoron in the American language. Mr. Rose points out that the other way to go here is with the digital dollar. And the reason he opposes that is he wants to have financial privacy. That's right. If you want to be a drug dealer, you need financial privacy. If you want to evade our sanctions laws, you need financial privacy. But the big market is the tax evaders. The IRS has testified that we've got $1 trillion of uncollected taxes, chiefly from billionaires in this country. That means they have to hide $3 trillion of income every year. That's the big market for this. I first got involved in crypto because it blows a giant hole in what has been the most effective element of national power, and that's our ability to impose sanctions. We differ on the Iran sanctions bill in this the Iran nuclear deal, but we were able to order every country in the world to not buy Iranian oil in excess of the amount we specified for that country because of the role of the US dollar. Some would say that got us a great nuclear deal. Some would say it should have gotten us a better nuclear deal. But if this works, we're not going to have that power anymore. You can build a couple more aircraft carrier groups at great expense, but it ain't going to give you the power that we had at that time. My concern is what happens if this works as a payment system. It is designed to compete with the US dollar. I think Mr. Davidson had it right. Here in Congress, we spend money like we're Democrats. We impose taxes like we're Republicans. And we got a fiscal deficit that would make Argentina blush. If we didn't have the US dollar playing the role that it does, our economy would be worse than that of Argentina. So if this works, it's a problem. We have people here concerned with either helping billionaires make money or maybe helping consumers not get ripped off while the billionaires make the money, but we don't have anybody on our panel concerned with the power of the United States through its US dollar. Now, we've got the McHenry bill, which allows you to go to any one of the 50 states and make them your regulator. So you supposedly have one-to-one backing for your money, but you pick your auditor out of any one of the 50. And it certainly gives you the opportunity to have less oversight and eventually not to have support. Mr. Davidson points out that the inflation means that the dollar is worth less. That doesn't mean stablecoin preserves value because these stablecoins are tied to the value of the US dollar. They're never worth more than 1-to-1. They can be worth less if you have fraud, and you invite fraud by saying, go to the state that has the least effective audits. Finally, there is the use of private wallets. Now, those who talk about fiat currencies will say, hey, I've got a private wallet. You can't put, conveniently, $1 million in this. Federal government doesn't regulate it, but how much money can you put in it? In contrast, we're going to have a stablecoin system that's like an iceberg. Some will be above the water and we'll see it, but then you'll have private wallets below the water that will be a lot more efficient for tax evaders, drug dealers, and sanctions evaders. I can't believe I still have an additional 40 seconds. I will also point out that this stablecoin is not some hip new thing. It's as hip as John Quincy Adams. We already had this in the 1820s. Banks would issue their own currency, similar to what Ms. Wang was talking about. But the digital dollar, if we develop it, well, I want to add one more thing, and that is we already have money market funds. They work much better than stablecoin as a payment system now, and we can make them much better than they are now. You can tie them to a debit card. The only problem is they have know your customer rules, and that means they're not good for tax evaders and sanction evaders, and I yield back.
The gentleman yields back, and the chair reminds all members that there is no loss of prestige by yielding back in less than 5 minutes. The chair recognizes the gentleman from Wisconsin, Mr. Stahl, for 5 minutes.
Thank you very much, Mr. Chairman. Thanks for holding today's hearing. I think it's a really important topic, Mr. Homer. If I can come to you, one of the things I think a lot about is how we make sure that the development of these products isn't overseas, but is rather in the United States. A lot of times I think about the challenges that I have with big tech, but if I look at all the challenges that I have with big tech, I think I can't even fathom to wrap my head around the challenges that we would face if instead of having US domiciled companies at the forefront, if all of our big tech companies were like TikTok and were developed outside the United States, the challenges that we would face. We're at the infancy in some ways of this technological revolution. I want to make sure it's remaining and developed here in the United States with our values rather than international values, as well as the jobs and value that'll come from that. And so as I look at that, do you believe that the proposed McHenry legislation will provide innovators with the certainty they'll need to invest here in the United States?
I do. And I can expand. I mean,
Yeah, no, that's good. Okay, straightforward answer then. So Singapore has enacted a regulatory framework for stablecoins. So let's examine Singapore's experience as we craft our own framework here in the United States. Anything specifically we can learn from the Singapore experience?
Sure. I think we were saying. I think one thing that's important to note is that stablecoins will happen regardless of whether we want them to happen or not. U.S. dollar-denominated stablecoins. There's nothing stopping offshore entities from doing this already. We should have it done in the U.S. so we can regulate it on our own terms. We can learn a lot from stablecoin frameworks being proposed in other countries like Singapore and the EU. In some ways, they mirror much of what is reflected in this proposal regarding reserve requirements. I think one feature that is different than you see in other markets is a tiering. Under this proposal, someone who issues $5 of stablecoins is regulated in the same way as someone who issues $5 billion worth of stablecoins. And in other country proposals, we see a tiering in terms of regulatory requirements.
That's helpful. Thank you very much. Let me stay with you, Mr. Homer, if I can, but let me shift gears somewhat dramatically. The SEC recently issued a Wells notice to Paxos that alleges stablecoin BUSD is a security. We all know one of the key prongs of the Howry test is that there be an expectation of profit. Could a purchaser of stablecoin have an expectation of profit?
I mean, a user of a stablecoin, it's hard to understand how they could have an expectation of profit.
And so you would then agree that stablecoins are not securities based on your your answer, correct?
Correct.
Thank you. I think that's important for the record. Let me shift gears, if I can, to you, Mr. Portilla. I'm assuming you've had an opportunity to review the ranking member's alternative proposal ahead of this hearing.
I have.
Did you review the section of the legislation titled Risk Management for Contracted Services, which requires federal regulation of payment stablecoin issuers, affiliates, and subsidiaries?
I did.
And would you agree that the legislation requires an entity without an existing federal regulator to be regulated by the Fed?
That's correct.
So is it fair to say that entities that may not issue stablecoins but instead engage in other market activities would end up being regulated by the Fed?
Correct, if they provide the services in that section.
And would you agree that this is outside the scope of the Fed's normal regulatory activities? Let me pause there.
It would be a new responsibility for them, right?
Is this even in the Fed's area of expertise?
I don't want to speak for them, but to my knowledge, no.
And so it appears to me to be a bit of a question as to why we would look for the Fed to engage in a regulatory oversight role that's outside their area of expertise. So I appreciate your feedback. I think it's broadly problematic. I think it would further cause market confusion and potentially conflict with other regulators. I appreciate your time. Mr. Chairman, since you noticed I could yield back time with no disgrace, I will yield back to the chair. Thank you.
The gentleman from Wisconsin yields back in a most gracious manner. We recognize the ranking member of the full committee, Mrs. Waters, for 5 minutes.
Thank you very much, Mr. Chairman. Mrs. Reynolds' hand, the Democratic compromise draft that I posted for today's hearing includes several critical provisions that's missing from the Republican draft. One of them would give the Federal Reserve Board the option to decline any registration of a state-approved stablecoin issuer. This aligns bank and non-bank stablecoins issuers with the current process we have for state-chartered banks and would ensure a strong federal floor for registration. This means that stablecoin issuers could not engage in regulatory arbitrage. Can you elaborate on the importance of giving a federal agency like the Fed a role to approve payment stablecoins before they are issued?
Thank you for the opportunity, Ranking Member. In this country, there's a strong role for federal regulators in approving all banks, the backbone of consumer finance. And the cryptocurrency and the Fed overlap when banks hold cryptocurrency as an asset on their balance sheets. And in the last couple of years, we've seen that when the traditional banking system and DeFi begin to intersect, it can create significant questions and structural issues. For example, although stablecoins may peg their value to the same real-world asset, stabilization mechanisms vary greatly. So this is one of the reasons why they have the effect, payment stablecoins can impact the monetary system, and why we need a role for the Fed in the same way that there is the role for federal regulators to approve state-chartered banks. There has to be a role for the state, for the Fed to review applications and reject them if they don't meet certain requirements.
Thank you. That's an important issue that we're dealing with stablecoins. Let me move on. One of the most devastating impacts of the FTX collapse resulted from intentional lack of customer asset segregation. The assets of FTX's customers were used to fund personal loans for senior FTX staff and funnel into FTX founder Sam Bankman-Fried's trading from Alameda Research. Customer funds were commingled with the firm funds. When the exchange collapsed, Commingle-led customer assets largely vanished and to this day are difficult to recover. Some are unlikely to be recovered at all. However, this is a different experience compared to FTX Japanese customers who were largely made whole because Japan passed strong regulations against the commingling of funds. Unfortunately, only a few months after the FTX collapse, the Republican stablecoin draft allows for the creation of stablecoins but has no oversight of the wallets where they would hold them. Can you describe the importance of customer protections like the complete segregation of customer assets by issuers, exchanges, wallet providers, and other entities? What are the dangers presented by firms commingling customer assets with the firm's own assets?
Briefly, custodial structures help protect consumer funds. And it is important because if a firm goes bankrupt, then consumers need to have a clear pathway to be able to recover their funds. And as we saw in a court ruling in Celsius, there's a clear gray area there, and we need clear rules of the road, particularly around custodial wallets. We need a segregation of consumer funds in these instances.
So commingling is a serious issue. Again, we've seen it with FTX, and we should be aware of that. And that's one of the issues we've got to resolve in this legislation. Thank you, and I yield back the balance of my time.
Gentleman yields back. The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Homer, I want to just run through some hypotheticals with you as we think about some of the mechanics of this bill. If I'm a broker-dealer of conventional equities, am I legally allowed to unilaterally halt trades on a volatile security, or do I need to have the regulator's approval for that?
I don't have the answer to that question right now.
It's a yes. I would hope we would agree that we would not want to give broker-dealers that power, given the conflicts of interest. I asked the question because from March 10th to 12th, Coinbase made a unilateral decision. Coinbase, who was registered as a broker-dealer, made a unilateral decision to pause USDC conversions after Circle disclosed that they had $3.3 billion in exposure to Silicon Valley Bank, and they lost their peg. So should exchanges that are registered as broker-dealers in the crypto space, is there something unique about crypto? Should they have authorities that we do not give to other broker-dealers because of the conflicts of interest? It's just it's not a super complicated question.
I think that anyone who's registered as a broker-dealer should experience a consistent set of regulatory
Okay, well,
requirements.
that's great, because the implication of that is that cryptocurrency exchanges should comply with securities laws and be registered with the SEC. Second question, Mr. Homer, I was trying to read your background, and I don't know how long you've been at this fund, but you're the managing member of a venture capital fund, is that right?
That's correct.
And do you guys invest in crypto firms?
In companies, yes, not in tokens.
Okay. Do you receive or buy cryptocurrency tokens in connections with those investments?
We have not.
Would you be open to that possibility, the right deal and the structure?
I would not preclude it.
Okay. So if you did, once your contractual lockup ends, however long that is, you're then allowed to sell those tokens to the public immediately, right?
It depends on how it's structured, but in your scenario, it sounds like yes.
I'm just saying legally. I'm not saying how you might structure. I'm just saying, like, just as a venture fund, your lockup period's over.
Sure.
You can sell
Yes.
that back. Because if you were subject to SEC registration, those would first have to comply with Section 5 of the Securities Act and be registered with the Commission, right?
I'm guessing the answer is yes.
And furthermore, if you're getting paid in these crypto tokens, you don't have to comply with Section 12A1 that would allow individuals who might feel that they'd been defrauded to sue you. if there was some sort of, something that they thought was a, fraudulent conveyance or something else, right?
I'm following.
I raise all this because this lack of regulation in the crypto space, and I'm not saying anything about you personally, don't take this, I'm just saying because you're the only VC guy up here, it allows crypto startups to bypass regulations so that you could exit your position quicker, even if it's defrauding investors. I'm not saying that's your intent, but I'm saying there's a whole lot of problems here with this lack of regulation, and I frankly don't think that either of these bills go far enough to address that. The next piece is, do non-bank stablecoin issuers have a fiduciary obligation to meet customer demands for redemption?
Yes, they would.
Okay, so when Circle saw that SVB is going under, they tried to pull the $3.3 billion out. They were meeting their obligations to their customers, right?
Yes.
Okay. Now, in the case of SVB, $3.3 billion, it wasn't going to make a difference in the overall troubles that they were facing, but it's real easy to imagine that money being in a smaller bank or stablecoin succeeding on the way we're talking about, and this all of a sudden being a massively destabilizing event on our fiscal system, right? If you've got this obligation to pull, right?
Yeah, I mean, this is why I think prudential supervision is important, and prudential supervisors are the best
No, it's,
regulators.
I think there's a different issue here. There's a good case for blockchain, there's a good case for Web3, there's a good case for distributed ledger. Why are we creating a currency within that mix that has access to our financial system? If you want to buy this pen for 3 magic ponies, we can do that. That's a barter transaction. Why are we connecting this to our financial system? And I guess, Ms. Reynolds' hand, I guess I would just leave to you if you have any final thoughts on what the risks are that we expose ourselves to.
The gentleman's time has expired. I'm just sensitive to it since we have votes on the floor, and I want to get to Mr. Green, and I yield to Mr. Green for 5 minutes. And at the end of Mr. Green's questioning, the hearing will be adjourned.
Thank you, Mr. Chairman. Thank the witnesses for appearing. And let me just start by indicating to you that I'm very much concerned about the stability of our currency. There is a war for currency supremacy. This war for currency supremacy is one that involves countries that don't always have our best interests at heart. And our reserve currency is preeminent. It is something that we treasure, but our position in the world is dependent to a certain extent on the validity of our currency. People trust us because of the validity of our currency. They invest in our country, in our treasury, because of the validity of our currency. So my concern emanates from this belief that we must proceed with caution, and as we proceed with caution, we must keep in mind that the system we have, it has some flaws, but it ain't bad. It ain't the worst system in the world. And I want to be very careful about how we do things to impact a system that is fairly efficacious. It seems to be something that others would love to have. In fact, they try to create it on a daily basis. So here's my concern for you. Non-bank financial companies. Non-bank financial companies can issue stablecoins. What kind of power are we giving to non-bank financial companies when they can issue stablecoins? In a sense, someone might say they're issuing currency of a sort. So why don't we just start with you, Ms. Reynolds Hand, could you kindly comment on what we will be doing when we do this?
Congressman, I completely share your concern. I was on the Hill as a staffer during the last financial crisis, and since then, we've continued to see the proliferation of non-bank financial services, i.e. fintech, explode and eclipse, in some parts, the traditional banking system. And that's a primary reason why we do need some clear rules of the road. Unfortunately, via the mobile phones that consumers walk around with, consumers now have access to these digital assets, but they severely lack protections. And so that is the only reason why there is a need for legislation and clear rules of the road in this space. But I do share your concern about how we proceed forward. We have a strong financial system. We have some solid principles around which that system is based. And yet, because there's clear vagaries and gaps in terms of regulation and rules, new entrants are always entering the space and engaging with consumers without adequate protections.
Thank you. Ms. Wang, just an additional predicate before you respond. Our fiat currency is the envy of the world. Everybody wants a dollar. If we allow circumstances to continue unabated without the legislation, what kind of impact will non-financial companies, what can happen? Give me your opinions as to how this can metamorphose into something.
Thank you, Congressman, for the question. I think on a global level, countries want to de-dollarize. They want to have the dollar be less influential in international trade. So if there are competing stablecoin legislations elsewhere, they're going to promote their own national currency and de-emphasize dollar-denominated stablecoins. So having this bill, right, would allow us to stay competitive. And as you said, the U.S. dollar is the reserve currency. I believe that, and I understand the concerns you have, but don't paint all of us with the same brush, because there are those of us who may be non-bank financial institutions, but we're community organizations, we're grassroots organizations. We support the work of local community banks, and we're doing that work to ensure that the U.S. dollar works harder, and by allowing us an opportunity to also...
Let me intercede. The chairman has been very generous. Thank you, Mr. Chairman.
Mr. Green,
I
thank you.
close with this, Mr. Chairman. I'm a supporter of Ms. Waters' bill. I'm going to do what I can to help us to have a good piece of
I
legislation.
thank the gentleman from Texas. I thank our witnesses. Appreciate your patience. We have 2 votes on the House floor. We have other members who do have some questions. It won't be that many. We ask your indulgence, and the committee will stand in recess until after votes.
Committee will come to order. I now recognize myself for 5 minutes. My colleagues across the aisle have asserted that all stablecoin issuers must register with federal regulators before conducting business, including those that are regulated on the state level. Mr. Homer, all those stablecoin issuers that go through the state pathway are not also required to register with the Federal Reserve under the McHenry proposal. Would there still be a significant role for the Federal Reserve to play, and what would that role be under the McHenry proposal?
Yeah, thank you for the question, Congressman. There would be a significant role for the Federal Reserve to play in that scenario, namely in two ways. The first being backstop supervision. So the Federal Reserve would have access to the books and records of the companies that are regulated by the states and would have the ability to step in if they felt they were not being properly regulated, and also would be able to take enforcement actions.
Thank you for that. Both proposals noticed to this hearing establish a list of factors that federal regulators must utilize when considering an application for a given stablecoin issuer. Again, Mr. Homer, would you discuss the factors in the McHenry proposal and how they provide the bounds for what the banking regulators may and may not consider?
Yes, thank you for the question. The factors include the financial requirements, including reserve assets, et cetera. It includes character and fitness of management, and it includes an analysis of risks and benefits.
And what are the consequences of including more open-ended or subjective factors as contemplated in the Waters proposal?
There are trade-offs associated with doing that. For companies, applicants in the space, it makes it more difficult to understand your requirements and to put together a complete application. And for regulators, it would give them significant discretion to reject applications based on a potentially unlimited set of reasons.
And if our objective is to provide certainty and a framework from which the market can operate, would the McHenry or the Waters proposal accomplish that objective?
Yes, I think that the first notice proposal would provide greater certainty.
Thank you. One risk identified in the President's Working Group report on stablecoins was a lack of transparency. Mr. Portilla, would you describe how the draft legislation attached to this hearing could help provide transparency and how that transparency will in turn give consumers confidence in stablecoins?
Yeah, for sure. Thank you for the question. I think both of the proposals noticed for the hearing include provisions that would enhance transparency for stablecoin issuers. In particular, there's a requirement to disclose the issuer's redemption policy, to establish procedures for timely redemption, to publish the monthly composition of the reserve assets, to provide attestations of the accuracy of the report of those disclosures to the relevant regulators. And then there, in fact, are criminal penalties associated with false attestations, which should provide significant incentive for management to make sure those attestations are correct and provide accountability for when they're not.
Thank you for that. Some have claimed that the state regulatory framework under Chairman McHenry's legislation will be insufficient to address anti-money laundering and financial crime issues with stablecoins. First of all, the bill requires all stablecoin issuers to be treated as financial institutions for purposes of the Bank Secrecy Act, which levels a number of requirements, including registering with FinCEN and submitting suspicious activity reports. States may add additional enhanced requirements under their framework. Mr. Homer, again, can you describe how the New York DFS considers anti-money laundering compliance when determining whether to approve the application of a stablecoin?
Yeah, thank you for the question, Congressman. It's one of the most significant factors. New York is a leading regulator in the space, but it's not an easy regulator, and it's still very challenging for companies to get approval in New York, and rightfully so. This risk area is one of the most significant areas where companies, I would say it takes them a while to really adequately meet those requirements. So the requirements in New York are incredibly robust and look at the policies and procedures a company has related to this issue, including ensuring that adequate KYC is being done at time of issuance and at the time of redemption of stablecoins.
Thank you for that. I yield back. And with that, the chair now recognizes Representative Nickel from North Carolina for 5 minutes.
Thank you so much, and I want to thank Chairman Hill and Ranking Member Lynch for holding today's hearing, and thanks so much to our witnesses for being with us here today. I'm hopeful that we can come to a bipartisan agreement on stablecoin legislation, as the status quo is both risky for consumers and stifling for innovation. We also have the opportunity with stablecoins to reinforce the dominance of the US dollar as the global reserve currency, all while making it stronger, more accessible, and more competitive. We're already seeing challenges to the dollar's influence, with the share of dollars in global currency reserves decreasing from 66% to 58% since 2015. If the dollar were to lose its status, there would be negative impacts across our economy, in addition to national security concerns. The dollar is the asset underlying 98% of stablecoin transactions. As stablecoin use increases, the dollar will only get stronger. By passing bipartisan stablecoin legislation to provide regulatory clarity and improve the infrastructure on which the US dollar travels, we can ensure it remains the global reserve currency. Mr. Homer, I'd like to start with you. Can you please describe the role of stablecoins in supporting US dollar dominance?
Thank you for the question, Congressman. I believe stablecoins are the most significant way in which the U.S. government can ensure continued dollar dominance in a digital era. We are seeing a transformation of money from analog to digitized, and we're moving toward a digital native era, which stablecoins represent. And we see that in the form of users in other countries wanting to hold U.S. dollar-denominated stablecoins. If we want to maintain our ability to engage in economic statecraft and use tools like sanctions, having stablecoins be issued from the U.S. is essential to that objective.
And you kind of touched on this in your answer here, but I'd like to hear more about the national security implications of the dollar losing its status as the global reserve currency. How would this impact the effectiveness of our sanctions, having stablecoin legislation?
Yeah, sanctions tools are only effective to the extent to which payment instruments or payment systems are denominated in dollars or involve U.S. leadership. And if significant stablecoin issuance were to happen outside of the U.S., it would lessen our ability to use sanctions tools in the future.
Yeah, I think we're really close on a lot of the different forms of legislation that I'm seeing, but I'm concerned about the Federal Reserve Board having a very broad veto authority to decline registrations by state-regulated issuers of stablecoins. Are there certain scenarios where you think the Fed should have this veto? How could we narrow this to keep a strong federal floor while also preserving North Carolina's ability to regulate stablecoins in our dual banking system? Mr. Homer?
I think we can look at some of what has happened in other countries, places like the EU or even Singapore, where there is a tiered approach, where issuers who are below a certain threshold can be subject to subnational regulation or a different regulatory regime. But once you've reached a systemic or significantly important level, certainly then I think it would make sense for enhanced oversight.
Thanks so much, and I yield back.
Gentleman yields back. I recognize myself for 5 minutes. First of all, I want to thank all the witnesses that are here today. My number one concern on stablecoins is ensuring that there is a robust state pathway for stablecoin issuers. Much like the dual banking system, there should be an opportunity for stablecoin issuers to be regulated at both the state and the federal level. This is important for a few reasons. First, it makes it possible for states like Nebraska to come up with our own regulatory frameworks for stablecoins. Over time, states will learn from each other and adopt best practices from their neighbors, reaching consensus on common issues and ultimately better regulation across the board. The problem with only federal regulation is that it doesn't undergo that natural, iterative process. Instead, you have this top-down approach that might be more difficult to change over time, and that's not a system that fosters innovation. And it's hard to argue that America's financial system, built on this two-tier federal and state approach to regulatory to regulation of banks, hasn't yielded great results for the United States. In the case of stablecoins, we're talking about something that we may very well have to revisit periodically as blockchain technology and its use cases continue to develop. It's much better to have several state regulators working in this area than just one or two federal regulators who may require an act of Congress to make technical changes. Additionally, it creates opportunities for states to develop specialization. Regulators can establish a reputation as knowledgeable on a particular set of issues Such a reputation can then become a reason for a business to locate in that state. My hope was to develop precisely that kind of environment in Nebraska when, as a state senator, I wrote and passed the Nebraska Financial Innovation Act. Ms. Wang, in your testimony, you compared the state regulatory pathway for stablecoins to the, quote, laboratories of democracy that constitutional scholars write about. Can you elaborate on this point and on the importance of allowing states to write some of their own rules?
I think that the state regulatory pathway is absolutely critical for grassroots innovation, without which we would not be able to have true bottom-up diversity and inclusion of our financial system. These grassroots innovators, they're for the community, of the community, by the community, and we should be allowed to experiment and to fail safely. Under Chairman McHenry's proposal, we would already be required to meet the minimum federal guidelines for issuance under Section 4, backstopped by Federal Reserve Board in the event of exigent circumstances. In my view, there's no constitutional reason to preempt state regulation in the case where not all stablecoins may necessarily implicate interstate commerce.
Thank you for that. Mr. Homer, one of the claims we hear occasionally, and we heard it today about a state pathway for stablecoin issuers, is that it could lead to a so-called race to the bottom. As a former New York Department of Financial Services Executive Deputy Superintendent, would you mind just responding to that claim?
Yeah, I think under the proposal, it would be very hard to imagine a race to the bottom. A federal standard is established, which is basically the New York standard. I mean, it's New York best practices that have been tried and tested and proven would be established as a federal floor.
I'd like to close by speaking just a little bit on the two drafts noticed for this hearing. I want to say this. I'm glad that Ranking Member Waters and the Democrats have come forward with a stablecoin proposal. I am hopeful that we can take serious steps on this and lead, because the United States needs to lead here, not just for our country, but for the world. However, when I look at the Ranking Member Waters' bill, the state pathway includes the following provisions. Number one, state-issued stablecoins must register with the Federal Reserve, and the Fed is responsible for creating registration requirements. Number two, the Federal Reserve is directly responsible for regulating and examining the state issuer. And number three, the Federal Reserve may, if it chooses, enter into a memorandum of understanding where it could delegate some of the regulatory enforcement obligations to the state regulator if they so choose. To summarize, the Federal Reserve would be in charge of processing applications, regulation, examination, and enforcement. That's the whole ballgame. The Federal Reserve would be responsible for all the nuts and bolts of regulating and overseeing state issuers, and they would delegate some of their responsibilities only if they so choose. To be frank, that's just not a state pathway in any meaningful sense. And this is my number one focus as a member of this subcommittee, is to maintain a state pathway, an opportunity for all of these laboratories in our democracy, all of the different states, to be able to participate in a true two-tier system. With that, I yield my time back. I recognize Mr. Torres.
Thank you, Mr. Chair. There's been a suggestion that state regulators cannot be trusted to regulate state-licensed stablecoins without parental supervision from the Federal Reserve. If state regulators can be trusted to regulate state-chartered banks, then why can it not be trusted to have analogous authority with respect to stablecoins? Regulating fractionally reserved banks that take on credit risk strikes me as far more complicated than regulating a fully reserved stablecoin that takes on no credit risk at all. So, Mr. Homer, can you explain to me why there should be a strong state option for fractionally reserved banking, but no strong state option for stablecoin issuance? Imagine you're ChatGPT, and I'm a 5-year-old. Please explain the logic that underlies that criticism.
It's really hard to make a rational argument for that. I think, as you point out, fully reserved stablecoins and other forms of non-bank companies don't hold the same type of risk as fractional companies. And states like New York have really been the primary chartering entities or regulators for non-bank companies for the history of the United States.
So it certainly should be possible to set a federal floor that prevents regulatory arbitrage, that prevents a race to the bottom, without subordinating state regulators like DFS to the Federal Reserve.
Absolutely.
Okay. And let's be crystal clear. State regulators like DFS have been more effective at crypto regulation than the federal government. The SVB collapse happened under the watch of the Federal Reserve. The FTX Ponzi scheme happened under the watch of the federal government. Federal regulators like the SEC spent more time targeting Kim Kardashian than Sam Bankman-Fried. And so the evidence is crystal clear that we've been poorly served by the SEC's regulatory ambulance chasing. As far as the lessons learned from FTX, those lessons should inform the development of a federal framework for regulating stablecoins. A lesson learned, stablecoins should be fully reserved, and those reserves should consist of 100% cash or cash equivalents. Raise your hand if you agree. I imagine all of you agree, but. Lesson learned, stablecoin reserves should be verified not only by self-attestation, but also by a third-party audit. Please raise your hand if you agree. Customers should have the right to immediately redeem a stablecoin on a one-to-one basis. Please raise your hand if you agree. And stablecoin issuers should be prohibited from lending, leveraging, or commingling customer funds. Please raise your hand if you agree. A federally licensed stablecoin issuer should have a single federal regulator. Too many cooks in the kitchen creates regulatory confusion and duplication. If a stablecoin is a currency regulated by the Federal Reserve or a trust regulated by the OCC, it should not simultaneously be a security regulated by the SEC. Do you agree with that, Mr. Homer?
I do.
There's a common misconception that crypto threatens the status of the dollar as the world's reserve currency, but the experience of stablecoins have shown the exact opposite. The fact that most stablecoins are pegged to the dollar reinforces rather than challenges the reserve status of the US dollar. Mr. Homer, you actually referenced competition when it comes to, my understanding is that in the realm of financial technology, China has largely been outcompeting the United States. The only fintech battleground on which the United States has been outcompeting China has been the domain of digital currency. Stablecoins, dollar stablecoins, have been far more successful than China's failed attempt at a CBDC. Is that a fair assessment?
It is a fair assessment, and that's because that's what people throughout the world want. People want U.S. dollar-denominated stablecoins.
And a common refrain heard from critics of crypto in Congress is that crypto has no use case. But it seems to me blockchain enables real-time transactions, stablecoin tokenizes the dollar, and the ability of a tokenized dollar to move at the speed of the blockchain creates a better, cheaper, and faster payment system, which would include the potential for better, cheaper, and faster remittances for the lowest income Americans. Is that a fair assessment?
A very fair assessment, and we're already seeing that happen.
And would anyone else want to comment on the use cases of stablecoins? The enthusiasm is overwhelming, I know. The 8 seconds you have? Okay, other than that, I'll yield back.
Gentleman yields back. I'd like to thank all of our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask that our witnesses to please respond as promptly as you are able. With that, this hearing is adjourned.